Good afternoon, everyone. JR with Secure Metals. Bringing you some market research here on the precious metals market. Today is the second day of June, and it's 12:15 p.m. Eastern Standard Time. No charts on this video. I will do a follow-up video with some charts. This is really just some articles here that I found pretty interesting. For all the, of course, we'll have the link below to all the articles that I show here, so you can see them in their entirety. I'm not going to read them all, but so here's the first article. Here this is May 27th, Tuesday of last week. Okay, this is by Zero Hedge. It's that time again, like clockwork, as 8 a.m. rolls around. Gold and silver become the object of derision for some entirely unrigged decision maker at a bank, pressing the gold prices down to a 3-month low. The question is, will the selling prompt more buying like on Friday, or beget more selling, because it is after all a Tuesday with 450 million notional flush through futures contracts? Someone was in a hurry after seeing Europe's extreme left and right uprising to unload any protection against an ECB capable of only one trick to save the world. So a huge sell order on a Tuesday, 8 o'clock. This is before any news. This is a day or 2 days before revised GDP, quarterly GDP, which came out extremely negative. So who's going to make a $450 million gamble and short gold? So again, this did prompt more selling. As you can see here, this was Tuesday of last week, and you had the prices were steady at 1292, and you had a huge drop, pushed the prices down all the way down to 1260 to 1263. So again, I'm always asked if I think this market is rigged or if I think there's manipulation in this market. I don't know is always my answer, but I can tell you that if you have $450 million to short something, I don't think you would short a safe haven while Ukraine is going through serious unrest and while you have GDP quarterly numbers coming out in just a day or two. So those are the types of questions you want to ask yourself and I guess come up with your own answers, right? Second article here is by Silver Seek. Silver to gold ratio, 27 years of data. This is a good article. You might want to read this. It really talks about fundamentals and talks about the ratios, 100 silver to gold ratio since 1986. So you had some peaks back here in 2011. So anytime you see this high, basically the prices are going up, and when you see this low, the prices are going down, and this is where we are right now. So it looks like the ratios are starting to find a balance here, so you might dip a little bit lower here, but ultimately this is where you're going to find some support here on the ratios, and obviously looking for another move like this. So any day now, any week now, any month now, we are expecting silver prices to rally. I like silver better than I like gold currently, because silver currently is much lower than compared to gold is, right? So I'll read some of these fundamentals here, but the charts really speak for themselves, so I'm not going to read all this, right? Gold demand is strong as China, Russia, and India, Western central banks have leased some or perhaps most of their gold. The German gold stored at the New York Fed was not returned, possibly because there is no longer in the vaults. Which I don't know if everyone knows the story behind this, but Germany asked for their gold. France gave them some of their gold that they had stored. Of course, the U.S. is giving Germany issues about returning their gold, and basically they said that by the year 2012, I'm sorry, 2018 or 2020, I forget which one it was. I believe it's 2020. So they basically told Germany, look, we can't give you your gold just yet. Just give us till the year 2018, and we'll send you the gold. It's a reasonable bet that gold about 40% below its 2011 high, and facing large demand, dwindling supply, will rally in price over the next few years. Silver prices will follow gold prices, but rally farther and faster from their currently low and oversold conditions. Was the above analysis a conclusive proof that gold and silver prices must rally? Obviously not. But it strongly suggests silver prices have been correcting for over 3 years. It could rally at any time. Silver prices are currently low compared to gold prices. The ratios is at a low end of its 27-year trend channel and likely to rise. Silver prices fall faster and rally more rapidly than gold prices. When the prices of silver finally takes off, it will push the ratios ratio much higher, perhaps to a 0.03, 0.04, the equivalent of gold to silver ratio of 33 to 25. That's what we were. I think we were at 35 or 33 when we hit back in 2011. Many other indicators not shown here also suggest silver is too low, oversold, and ready to rally. The same is true for gold. Right, great article. Click on the link below and check it out. This is a very serious article here. Talks about the BRICS and how the Chinese and the Russian government have struck a deal here on gas, on oil. Okay, so again, I'm not going to read the full article, but I will go over this here. Again, also by Zero Hedge. All right, exit the petrodollar, enter the gas yuan. And then talking about anxiety in Washington, there's the fate of the petrodollar to consider, or rather the thermonuclear possibility that Moscow and Beijing will agree on payment for the Gazprom CNPC deal, not in petrodollars but in Chinese yuan. One can hardly imagine a more tectonic shift, with Pipelineistan intersecting with a growing Sino-Russian political, economic, energy partnership. Along with it goes the future possibility of a push led again by China and Russia towards a new international reserve currency, actually a basket of currencies that would supersede the dollar, at least in the optimistic dreams of BRICS members, right? So the BRICS being B for Brazil, R for Russia, India, what's the C for? China, and then S is South Africa, right? So great video. I believe the deal has already been struck, and it's a wrap. I mean, this is going to happen. I think this is going to be for the next 30 years. But again, you definitely do want to keep up with this article here. This is a great article. All right. This video also great. Not video, but this article here: silver, gold, and what could go wrong. I like this article here by Richard Russell. Is almost 90 years old and has seen it all. He recently stated, "My advice is, and has been, is to move to the sidelines while holding large positions in gold and silver, regardless of what the markets do. Silver and gold represent eternal wealth and the bid to sleep undisturbed at night. No amount of money is worth the loss of peace of mind. The power of gold opened the American West and populated Alaska. Men have spent their lives searching for gold. You can own gold by simple action of swapping Federal Reserve pieces of paper for the yellow metal. I advise you to do it." Right? He goes on and gives some great examples of how we are reaching the bottom, or hopefully we're very, very close to the bottom. This is a good chart also that explains the broadening wedge that we have on silver. And as you can see, we're at the bottom of this line here, so we could go much higher from here. And I like this last part because this is also, by the way, a silver Sikh. And I like this article because he goes on at the end here, and he basically gives you everything in perspective. What do we know for certain? The grass is still greener, the sun still shines, the government is still spending and spending and spending. The Fed is injecting liquidity, monetizing bonds, creating currency swaps, and printing money. Inflate or die remains the unspoken command. Silver and gold will continue their rise as the purchasing power of fiat currencies decline. Politicians talk, debt increases and people are realizing it can never be repaid. Gold and silver are still real money, even if they are suppressed, denigrated, hated, and lied about. Why should we expect anything different? There are some competitors to paper currency backed only by a full faith and credit of a currency which spends roughly 1 trillion more each year than it extracts in revenue. So what could go wrong? Let me count the ways. Derivative crash, another war in the Middle East, large-scale dumping of US T-bonds, failure of confidence in the US dollar, caused by loss of confidence in either political or monetary leadership, more foreign policy blunders, any war with either China or Russia, loss of reserve currency status for the US dollar, which again, I just read that Russia and China article, the BRICS article, evidence that most of the gold supposedly stored in the New York Fed is gone, missing, leased, borrowed, or hypothecated. What else could go wrong? Sarcasm alert. Congress balances the budget in an election year and causes an immediate depression. The U.S. government admits it will not repay its bonds. Financial chaos overwhelms the nation. China and Russia publicly apologize for criticizing the Fed's money printing and agree to all U.S. foreign policy objectives. The world is stunned into silence and then laughs. Israel and Iran declare peace and mutual harmony. Politicians swear that they will tell the truth and forego the use of teleprompters. China agrees to dump over 10 tons of gold on the market at a sub 500 price. And in the spirit of international cooperation, the S&P soars, gold crashes, and politicians spraying their arms, patting each other on the back. Goldman Sachs and JP Morgan announced they will donate 100% of their profits from proprietary and high-frequency trading in 2013 to charity. Financial and stock plummet, and politicians worry about the future payoffs. Bottom line, there is an abundance of risk in the world that involves other parties, other countries, derivatives, debt, and lots more debt. Gold and silver have no counterparty risk and will retain their value regardless of whether the debts are paid, regardless of politician promises, regardless of monetary and fiscal policy, and regardless of Bernanke yelling put. So great article here. Really puts things in perspective. And if definitely, at this point, if you don't own silver, if you're not taking these dips and really taking advantage of them, you're really doing yourself and you're doing a portfolio a disjustice. This is not a crash. This is merely a correction on the precious metals market. Again, you can't look at all these fundamentals and really think that something positive is, that this is going to end in a positive manner, because everything written here is 100% true. Okay, the only way I see gold and silver continuing to head lower is if everything corrects itself and the money printing worked. The money printing has never worked. Why would it work now? These are just extremely overbought conditions. Now we have a correction. You start buying now, stop slacking. Right, another article here, how inflation keeps the rich up and the poor down. I'll read a little bit of this. The production of money in a free society is another one by Zero Hedge. The production of money in a free society is a matter of free association. Everybody from the miners to the owners of the miners to the minters and up to the customers who buy the minted coins all benefit from the production of money. None of them violate the property rights of anybody else, because everybody is free to enter the mining and minting business and nobody is obliged to buy the product. Things are completely different once we turn to money production and intervention regimes, which have prevailed in the West for the better part of the past 150 years. Here we need to mention, let me put this here. Here we need to mention in particular two institutional forms of monetary interventionism: fraudulent fractional reserve banking and fiat money. The common characteristics of both these institutions is that they violate the principles of a free association. They enable the producers of the paper money and money titles to expand their production through the violation of other people's property rights. Banking is fraudulent whenever bankers sell uncovered or only partially covered money substitutes that they present as fully covered titles for money. These bankers sell more money substitutes than they could have sold if they had taken care of if they have taken care to keep 100% of reserves for each substitute they issued. The producer of fiat money, in our days typically paper money, sells a product that cannot withstand the competition of a free market monies, such as gold and silver coins, in which the market participants only use because the use of all other money is severely restricted or even outlawed. The money, in both cases, the production of money is excessive because it is no longer constrained by the informed and voluntary association of the buying public. And a free market paper money could not sustain the competition of the far superior metals monies. The production of any quantity of paper money is therefore excessive by the standards of a free society. Similarly, fractional reserves banking reproduces excessive quantities of money, substitutes, at any rate, in those cases in which the customers are not informed that they are offered fractional reserves bank deposits rather than a genuine money title. This is a great article. I'm running out of time here, so I urge everyone to read this article because it really talks about how dangerous the money printing press, the printing press is, and obviously having a cartel of banks in charge of that money. Okay, that's about it, guys. Hope you enjoyed the video, and look out for the next videos coming up right after this one as well. This is going to be a technical analysis. Enjoy your day. Bye-bye.